Thank you for joining us for our afternoon session. We've got another great investor-led panel discussion here. It's private equity under the microscope. And I'd like to invite Bert Koth of Denham Mining Fund to come up to the stage, Russ Cranswick of Resource Capital Funds, and Peter Ruxton from Tembo Capital to join me. So gentlemen, please take a seat. If you have any questions throughout as we go, please feel free to stick your hand up and we can interject. We'll try and keep this as conversational as possible. So we had a good start this morning, some insights onto how people saw the markets unfolding at the moment, how the last 12 months have been. But let's get the private equity take on how things have been. Bert, let's start here and then perhaps we can work our way down. How have the last 12 months been, do you feel, sitting from Denham's perspective?
Well, obviously, I mean, our perspective as private equity investors is quite different than from a public market investor. So the way how we view it, I mean, first of all, we are in principle less bothered by the fact if the metal prices are low and if the share prices are low, right? So that's of less of a concern to us. So from an entry point of view, we always differentiate between our entry and our exit opportunity. From an entry point of view, the market that we see at the moment offers a very interesting opportunity set, especially in the part of the value curve where we play as a fund, which is the development curve, where basically our fund takes control of assets with a view to actually develop them into production. There is, because of the capital starvation in the market, a very good opportunity set. So we see the market for our business model on the investment side as a positive.
Is that because valuations are a bit lower at the minute? Or
valuation lower, the fact that opportunities of a certain type are accessible at all. But it's not only about the valuation, it's also about the execution costs of business plans, right? Because typically when the market is more subdued, it's you get the A teams from the contractors if you build something than just the B teams. It's cheaper to get the contractors. So there's all sorts of benefits that come from deploying capital when actually the market is in a relatively subdued state as it is now. Now, there's a flip side to that coin, and that flip side is called the exit. So obviously when mining companies find it more difficult to raise capital, it makes it more difficult for them to acquire the projects from us when we seek an exit at a relatively full valuation. So there's never a perfect state, I would say, for mining private equity, because typically when the entry opportunity is great, it's typically when the exit opportunity is not in perfect shape and vice versa.
Yeah, so a waiting game of sorts, or picking your moments and working on exiting some, looking at acquiring others.
Picking your moments, that's a good way of putting it.
Of course, broadly. And how do you look at some of the long-term demand fundamentals? Does that build for certain commodities? Does that build into your selection process, or taking up some of these good opportunities that you mentioned around developers at the moment?
Well, it's a great point that you raise, because you really have a situation right now where the capital starvation in the entrepreneurial mining space, and that's both on the public as well as in the private market. So it's actually a shrinking pool of capital in our point of view, both publicly as well as privately. And there's a huge disconnect between actually the supply side response that in the long term will be necessary and actually the amount of projects that are going to get funded right now. Mm-hmm. So there's a huge disconnect between what is long term economically required and what the financial markets are willing to deliver today. Now, when we select assets for investment, we do, however, not factor in a price recovery on, right? So in the underwriting, and any private equity firm in the underwriting, they just have to use, and we just use conservative long-term price tags. So should we, during our investment hold period, encounter a scenario where, for example, the copper price or whatever price all of a sudden raises up for supply side reasons, that's an upside case. But you can never underwrite that as your base case.
Yep, understood. Okay. Russ, welcome to One-to-One. Tell us a little about your view from private equity of the state of the markets at the minute.
Sure. What we're seeing is, obviously, as everybody, the market is very starved for public equity, but also private equity. We can only invest in so many things, and that is an issue when we do see a couple of years ago, there was a bit of a brief coming out of Beaver Creek. There was a brief euphoria in the market turning, and instantly we're hearing every day about new companies being floated, new companies split out of single companies. That just floods the market, and there isn't the take-up on the PE side or even the public market investors. So what we're doing is trying to select the best we can within the universe out there. One of the things we really benefit from is co-investment, particularly at the earlier stages. We can backstop an equity financing and take a company that's treading water, not spending money on its projects, and activate a program that particular year, but we can't fund it every year thereafter. So we like to have co-investors that are either there and step up alongside us.
Who might that be typically, co-investors? Do you look for a certain type?
Sometimes it's resource-focused funds. Sometimes it's a high net worth individual who's a historic shareholder, but they don't want to carry the ball funding that program too. So they'll amalgamate around a seed funding that we can do. But that's the first year. The second year, we're probably more likely to be pro rata, such that we can't fund the $10 million that they require the subsequent year. So we have benefited from some of the stronger names where others, the broader market, helps fund those subsequently, such that with a minority position, we can actually exit and get a return, which allows us to come back in the future.
Okay. And Peter, your view from Tembo on the state of the sector at the minute? And
Yeah,
how
I think to be fair, we all expected things to get better this last year. We're supposed to be, we've had a bit of a downtime, we're supposed to be coming into a good time, but we haven't seen it happen. It's not happened, and valuations are still low. We've talked in Canada, they talk about marijuana taking all the risk capital out, and the Bitcoin or taking all the risk capital out. We're just starting to see markets opening a little bit in Australia on the gold side. One of our companies for Papua New Guinea has just raised 40 million Aussie for a gold project. So we're just starting to see the markets open again. And that's our biggest competitor, to be fair, for private equity. Our biggest competitor is the market, not other private equity guys. We generally, if we can, we like to invest alongside like-minded investors. Guys also think longer term. Guys also think about longer term creating longer term value rather than just flipping in and flipping out of a stock. So we often find ourselves in the same deals, and as Russ says, we carry the burden together, and we get these things up and running, and then we find the exit. And of course, ourselves, in terms of raising money, we need money to invest, so we have to go out into the market to raise money for our funds, and that's been tricky, and that's a shrinking pool of capital as well. So it's not just the money available for exploration guys or mining guys, development guys, it's also private equity capital's also shrunk over the last couple of years.
To come back to your point, you mentioned about exits and where you're looking for exits. And can you tell us a little bit more about the state of the exits in the current market, or how important exits are for private equity to keep that capital coming back into the fund so you can place capital into other projects, that kind of thing?
Yeah, I mean, exit's great. I mean, it's easy to put money into something, isn't it? It's always hard to get it out again. And when you get it out, we've got to get 2 or 3 times, otherwise, or more. Otherwise, our investors are unhappy, and we don't raise money from them. So because since the financial crisis, really, the market's been very much up and down. We haven't really had a good bull run. It's been mainly on the negative side. We haven't seen sort of the valuations we would have hoped. So a lot of private equity firms, especially those that started before the crash, have got a lot of red on their sheet, in their portfolios. A lot of companies haven't performed the way they wanted to. And so what we've got to do is to try and eke as many exits as we can out of today's market, still trying to get 2 times money or more, because that's the sort of exit number that starts getting our investors interested. And then we've got to go out to market. Tembo's been quite fortunate. We've had 3 exits over the last year and a half or so, and out of 12 deals altogether. And so we're in a position where we can now go back to the market, having returned about 150 million to our investor. But you need to keep that money recycling, especially the older you are as a fund. We've been going since 14, so just coming up to 6 years now. We're quite young. I mean, RCF, for example, started in '97. Yes, around about then.
Correct. Yeah, and I've been there about 20 years, so lived a few cycles, but definitely.
And you're on which fund are you on now?
We're on 7, and my opportunities fund is 8.
So 7 and 8. See, these guys have been around a long time, survived the financial ups and downs of the financial crisis. That's a pretty good effort. If you know, when everything goes down, when the tide goes out, every boat is stranded. Yes, and it's that when the tide comes back in, you've got to get your boats floated early and get them exited, and then go out and raise money yourself.
Yeah. Any further thoughts on exits and how you approach it in the current market, or is it?
From my perspective, investing at the earlier stages, we consciously took a perspective that we'd shoot for well less than control positions, in some cases targeting below reporting thresholds, such that we can be supportive on the entry, and while we're there, offer the benefits of the RCF platform, technical, legal, whatever it might be. But at the same time, when we are ready to exit and we've realized a return, we can go quietly without impacting the benefit that the company got from our support.
Yep. Okay. And you touched on your earlier stage fund there. Could you tell us a bit more about the Opportunities Fund, actually, just in terms of the sweet spot of where you look at, just for the audience? Yeah,
what we're focused on is exploration through pre-feasibility, and beyond that, that's where the larger long-term RCF funds focus on the construction phase. So we're investing anywhere from $500,000 to $5 to $10 million in that space. Obviously, higher frequency, smaller amounts at the exploration stage, but in the de-risking phases, we can fund a pretty material program to advance and de-risk projects, and we've been supportive in subsequent tranches as well.
Mm-hmm. Okay. So we talk about exits and like this returning cost of capital. But how much do you have to return to shareholders before you actually start to make a significant profit yourselves? Is that a big challenge at the moment? Bert, is that something as a fund manager is keeping you awake at night?
Well, it's no secret that most private equity firms run at a cost of capital between 8 and 10%, right? So I always say raising a private equity firm is like taking out an expensive mortgage from a bank, right? And that cost of capital basically compounds 8 to 10% annually. So let's run through simple math. So let's say you raise $1 billion, right? You spend it all on day number one. Over 5 years, and 5 or 6 years later you exit, right? So then you got to return $1.5, $1.6 billion before the fund makes any dollar profit for itself, right? So this is just a very simplified math. But what that means is that a private equity firm, in order to be profitable, must monetize probably 20 to 30% of its portfolio, let's say in the first 5 years, yeah. And that's just a simple math, right? That's not us being greedy fund managers or anything like that. That's just simply informed by mathematical realities. What are the returns requirements that investors who put money into private equity firms actually command of the sector? Mm-hmm. So when we select our targets, as Peter said, it's easy to put the money into something. It's much more difficult to get it out again, especially the profit, right? So when we go in, we already got to know how we go out, how we get out, and actually also when to some degree. And so for us, what it means also in investment strategies, we're gonna, unlike the RCF Opportunities Fund, this is why we play on the later stages of the value creation cycle. We typically assume the development risk, and it's a big risk to assume. Yeah? We assume the development risks to actually move the assets into production, because when you have it up and running, it's quite reliable that you're able to sell it, because even in a down market, there will be companies willing to buy a low-cost producing asset that got most of its life of mine still ahead of it. Yep. So that informs investment strategy, that requirement.
Yep, makes sense.
So this is why we always talk, when we investing companies come to the door, we always talk about the quality of your asset. Is it a good asset? Because to us, it's got to be a good asset to be able to sell it quickly and easily. And the easiest thing for us is we want to put money into a company. We want to help the company de-risk the asset and then sell it onto a major pretty quickly. And the better quality assets do that a lot quicker. If you look at commodities, actually, especially in today's market, it's generally the gold that does that quicker than most in our world. Both our Tembo's gold assets have sold, have exited. And so that, in my experience over the last 20 years in private equity, that really is a fairly common theme. You tend to put your portfolio a lot more gold than most. If you're looking at the whole spectrum, that is, or if you choose to focus, that's another thing. But if you look at the whole spectrum, about 40 to 50% of the deal flow is gold. And it's good that it is, because you can flip gold quickly. You see the gold market at the moment starting to come back before other markets in Australia. It's a good market to be in. And so for us, we're always looking for quality, low-cost gold projects in different parts of the world.
I think that's a good point Peter makes, that if the public markets are largely investing at that rate, 40 to 50%, you have to kind of mimic it as private equity. You can be counter-cyclical to some extent, but at the end of the day, you have to exit. So there has to be a demand by either the public markets, corporates, that type of thing. You can't deviate that far for that long.
Yep.
Agreed.
Yep. And do you like gold similarly, Bert, or is it less critical for you?
Yeah, at the moment in our current fund, we don't have gold exposure, but we're looking at a number of gold transactions at the moment. I mean, it is the most M&A liquid subsegment in metals and mining, no doubt about it.
Okay. At this point, I'll open to the floor if there's any questions at the moment. Yep, we've got one down here. Just wait on our microphone.
Thanks. Bert, you talked about using a robust base case scenario when you're investing, and I fully agree. I think in these markets you need to have that robustness. And I'd just be very interested in learning what sort of numbers you're using for different commodities, really. You know, what is a robust scenario these days? I mean, certainly $3 copper is no longer a robust scenario, for example, and
no.
I'm sure we can go through all the different things.
Well, it depends. So I try to give a kind of as general answer as possible, and obviously there are lots of nuances depending on the project. I would say bottom 40% of the cost curve, just as a matter of rough principle. Then it's not $3 per pound in copper, definitely not. But maybe not $2.50 or $2.30 or something like that. We typically look at unlevered IRRs and unlevered MOIs returns. I mean, obviously we would try to find debt capital, kind of to leverage off that, right? But we look at every project like, how does it look like if we have to fund it exclusively with our capital, right? So we typically look at like 20 to 25% unlevered IRRs. And it's about the ability of a project to withstand punches, right? And the punches is not only the market, the punch is also the reality of what happens when you build a project, right? Okay, you get through a zone with more difficult ground conditions. Okay, things take longer, right? Some equipment breaks down, a bridge gets washed away, etc., etc., etc. So this is just an industry where with regularity, especially in the commissioning phase of projects, just unforeseen things happen that ultimately it takes you more time, it's going to cost you more money to get to where you want to get to, right? And so therefore, the returns expectation has to be such that even when the things happen, that still when it's all done and dusted, you still end up with an acceptable return. Yeah. And so therefore you got to use very conservative underwriting, because that's ultimately your insurance policy against all the negative deviations that usually happen when you execute a mining project for real.
I guess the supplementary there would be, you know, we've sat through quite a lot of presentations today, good presentations on how, you know, global trade is actually just turning negative right now and this thing. So it sort of feels like a scary environment for commodity pricing still. And I would think that part of that robustness has got to be making sure you have a sustainable price for each commodity you're producing, really. And I was just interested in how you establish what that sustainable price is, really.
Can I comment there? I'll just push back slightly and say it's not all about the price, it's about the margin, yes? So we're price takers in our industry, yes? That's the way life is. So it's more about being able to control your costs. And if you can control your costs and have low costs, even a low copper price, for example, can still give you a decent margin. And you can still get a robust project and a robust return. And the other thing about choosing a commodity price is we don't always look necessarily just for one. We look at a range of commodity prices. And we look at the project, how the project behaves. What's its break even, for example? What's the minimum price we need to see for a 2 times return on our... and so sometimes we even use Monte Carlo simulation to look at the pricing. So it is quite complex in a way. The most important thing is the margin.
And to make it more complicated is also that the operating costs vary with price levels long term. There's a lag effect, right? But obviously when the prices really go into the cellar, after a while, to some degree the operating costs or some operating cost components are going to follow suit as well. But we run scenarios typically, so again, there's always exceptions because it depends from commodity to commodity, right? So if you look, for example, today at a potash project, right? Okay, potash price might be for the next 15 years at a 15-year low, right? So then you gotta be literally in the bottom 10% of the cost curve, and if you're not, you can't sleep calmly in your bed at night, right? While for other commodities like for copper, right, one can be a little bit more liberal where you sit on the cost curve. Let's say you want to be in the bottom 40%, but as Peter said, the key is really the margin that you get. So the way how we look at it internally, we say we got to make sure that the project still has a profitable margin under any realistically conceivable pricing scenario.
One more question down here.
Yeah, the interesting thing, Bert, it's, financing these projects with you guys, there's a hell of a difference to financing it with brokers, for example, because you guys always have a contingency built in because your experience tells you that something's going to go wrong. But what people should be focused on, I think now, is projects where there's a potential exit for the project by selling to a major. And that's what I had been expecting to be a factor in the market. And it's only happening at the top end at the moment. But you guys have each got projects which are, shall we say, ready for a major to take them on. But how do you manage the exit phase? All we hear about is the projects that you got that you're developing. It's the ones that you exit at a big profit that attract your private equity investors.
It's not only the majors, to be clear. We sold 18 months ago Silvertip to Coeur d'Alene, and Coeur d'Alene is not a major, right? But we run a bunch of exit processes at the moment. It's not only the majors. Actually, I would say most of the buyers are actually mid-caps and larger mid-caps. I would say this is actually the most acquisitive universe at the moment.
I think that's right at the moment, yes. So it's mid-caps and majors, but they're not buying at the minute, or not all of them are buying. As Bert says, the mid-caps, there's guys who've got one project or maybe two and they want to bulk up and they're taking a third on. But the majors are not putting hands in their pockets yet. They're still being cautious. And that's because of the global situation. Trump's position on trade is one that's holding things back. The Chinese aren't as active as they perhaps should have been in today's market. But it'll come. Be patient sometimes. But even then, within that being patient, you still got to get your exits. We have to raise the money for our funds. So, we need to be...
It used to be 5 years that you used to promise that we'll take it on and we'll sell it on within 5 years. But 5 years has become 10 years and a number of things haven't shifted. And I don't want to start being personal about some of the projects that you've got that are not happening, but you guys are the leaders. You're showing what the market should be doing, but I don't think there's enough projects that are being taken on by much larger companies. And I absolutely agree that the mid-caps have got to diversify. They've got to get critical mass because they don't have long life projects. So it's obvious.
So we're going to see they're going to have to step into the market, at some point. They're holding back. So what it means is it's going to all come in a rush. And we're going to have a big spike.
Yeah, it's going to be the first half.
You've then got to be ready.
You get gold at 1,600, you get silver at 20, you get copper getting back over to 3 to 4. Something happens in zinc so that the actual shortage becomes manifest. Yeah, you're going to get a total sea change. I mean, the valuations are going to jump because all of these mid-caps are suddenly going to realise that if they don't do the deals will never be totally de-risked. If they don't do the deals, they'll be toast. Investors have turned against management of mining companies. They're blaming management. And you guys are the leaders. You're supposed to be the judges. I mean, Bert there says he's made his whole career backing good managements, you know. Now he's at the top of the tree.
There is a scarcity of good management, I need to say that.
Yeah, I think what we're seeing, the fact that there isn't these exits of these single project companies, it emphasizes the fact that we as groups need to be co-investing to make these companies stronger, not just build the project and cling and wait, but be convincing about the working capital of it, enhance it, add a little more development capital to it, and then maybe lead that M&A yourself and create the next mid-tier. That should catalyze things. But the PE industry or the public capital isn't out there to fund those stronger mid-cap companies.
But to your question, how do we manage the exits? So typically when it's up and running, we appoint a bank, and that bank is running a competitive sell side process, and whoever pays us most for the assets in cash, I want to underscore in cash, we're not interested in taking other people's paper. Whoever pays us most in cash gets the assets.
Bring it on.
No, and
talk to me again in a few months.
To be honest, sometimes as well, before you appoint the banker, and you know, Bert does the same. You're already talking to the likely people. You've already identified them. So the best private equity deals, you've identified your likely buyers even before you put your money in at the beginning. That's the best form of private equity.
Okay, we've got about a minute left. One burning question at the end.
This is an area that doesn't seem to have been covered much at the conference, and there don't seem to be many of those companies here either, but this is for any one or all of the panelists. How do you see the so-called electric battery metals shaping up? Have you got involved in that sector yet, and which of the more esoteric metals like lithium, cobalt, graphite, etc., do you see have the most potential?
We'll have a batteries panel discussion tomorrow, actually, so tune in for that one. There will be some coverage of that, more granular coverage of the commodities. But just to wrap up, do you gentlemen see the battery materials being a bit more of a catalyst for mining again, kickstarting things, kickstarting the M&A and improving those exits that we
I mean, the way I look at it
talking
is
about?
Exit, yes. What are people buying? What are the majors buying or the mid-tiers buying? They're not buying all these lithium things and graphite things, etc. These markets are on the edge of. We like to play straight down the fairway if we can. So we'll play the electric vehicle through copper and through nickel. Is probably where we'll play the electric vehicle market. Others like to play more at the edges, and I know RCF in the early days had an association with a metal trading group that had really good insights into that, and they did some good deals, but they had the insights into the market, because it's all about the market for those. And it's, you know, how big's your graphite, for example, you know? And if you look at the number of projects out there, there's far too many projects out there to supply the actual market. So understanding these markets is not easy. And how many people are actually buying and exiting in those areas? It's not many.
Yeah, from my perspective.
Very difficult sector.
Sorry. Yeah, Kel, we've chosen to play it from the nickel space, similar to what Peter's saying. We've played lithium historically, done very well out of that, but more recently we've avoided it and cobalt, but would be starting to look at it again, particularly from the Opportunities Fund perspective.
Again, goes back to first principles. If it's really low cost, that it survives a really low cost price environment forever, then it's a potential investable proposition. Otherwise, it isn't. the lithium space was so over-promoted and overhyped that I have to say honestly, as a private equity investor, I'd rather sit back and wait until a lot of that crashes and burns, because there's a lot of these hard rock lithium projects that are clearly not economically viable longer term, right? I mean, it's typically when something's heavily promoted on the public market, it's typically a good time for private equity not to engage and just wait until others burn their fingers and then re-engage.
Okay, there you have it. Unfortunately, we're out of time, but we can go on that, and there is some content on battery materials tomorrow. But let's have a round of applause for our panelists. Thank you, gentlemen.